Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, strategy selection from a bearish perspective, we're really going to look at the same considerations. Now, here I have a snapshot of the EUI, the U.S. dollar versus the euro. And remember, we had that trend line drawn in place here and suggested that, okay, as long as the trend line is being respected, well, hey, we can look at trading this to the upside. But the consideration is that if that trend line breaks, well, we may have an opportunity to trade this particular pair value all the way down to retest those levels at 67. So in other words, our expectation would be that, hey, maybe this U.S. dollar is going to slide a little bit against the euro here over the next little bit, and we want to try to capitalize on that. So rather than jumping in immediately, we establish a benchmark. So we say, okay, first sign of a change in direction is going to be a break of that trend line. Second, I got to go back, sorry about the grammar, I have to go back, and I have to look at the previous pivot point, because if we think about one of the very simplest characteristics of trend identification, particularly in this case identifying a downtrend, is we need to see lower highs, which in fact we're seeing, but we also need lower lows. So that break to a lower low is confirmation that we need in order to facilitate us to take action and buy some put options. Okay? Now, we can also take these same observations from support resistance and establish price targets. So in other words, we would be looking at ultimately buying those puts on a break of, let's say, the 69 level, and our first target is going to be sitting down at that 67 level. So when the pair value actually migrates south down to that particular zone, we're going to say, all right, this is an important support level. I'm going to take some profits off the table. Okay. So with that in mind, we can use, again, the same observations to create a bear put spread. Now, the bear put spread, we have to have a directional bias. We have to have an entry point. So we can still buy our puts at that 69 strike, but ultimately, what we're going to do is we're going to sell off the puts below the 67 support level, and that will allow us to capture the difference between the strike prices minus the premium we paid. But it allows us to lower our break-even point, identify our risk exposure, or lower our risk exposure, and ultimately it compensates us for overpaying for our long put position. Okay, so that would be the consideration at this, with this particular chart. Now, we're looking at determining whether or not it's appropriate to implement any sort of an options writing strategy. Once again, as far as I'm concerned, the consideration has to do with whether or not we see any very strong support and resistance levels. So here we have the AUX, again, it's the US dollar versus the Australian dollar. And ultimately, you're looking at a reasonable support level across that 61 zone. You can see that it's been tested here, it's been tested here. Yeah, it broke through there for a little bit, but ultimately it held after a couple of weeks there, here, and here. So our consideration might be, you know what? I think the AUX is either going to go up or stay the same over the next month. So what I want to do is I want to go in and I want to sell those put options below that level with the expectation that they're going to actually expire worthless. Now, a lot of people go and try to collect as much premium as possible. Well, remember that the closer to the money we are, the more premium we're going to get. The closer to the money we are, the more risk we take that we're going to get ourselves on the wrong side of it. So for me, I like to look at these support levels for writing puts, because ultimately it gives me a little higher probability of being right on the actual outlook. Now remember, when you sell a put or when you sell a call in the absence of any other strategies, then you have an unidentifiable risk exposure. So it's important to consider anybody that looks to establish a strategy from an options writing perspective, that if you write those options, which is of course what we refer to as being naked, if you write those options naked, number one, your risk exposure is unidentifiable, and number two, you're going to have a higher margin requirement. Now, to answer Mike's question here, do I look for any minimum distance between strikes and placing the position? What I like to see is I'd like to see the potential of me being able to at least double my money based on the pair value, actually making it to my written strike. So in other words, let's say for example I was looking at buying creating a bull call spread, and I did a 61.50 to a 62.50. Okay, so that's a dollar spread. Then I want my option position to only cost me 50 cents. Okay, if I do 61.50 to 63, well then, ultimately I want my option position to cost me, what's that? To cost me essentially 75 cents to $1. So I want to make sure that there's sufficient room between the strike prices. I can double my money if it actually goes in my favor. So hopefully that answers your question, Mike. Now, a bull put spread, we're making the exact same considerations that we would make in creating the bear put spread, in that we're more or less looking for strategic levels to be the writer in this case and the seller. So in this case, I might consider selling puts at the 61 level. But remember, when I sell those puts, I have an unidentifiable risk exposure. But if I actually turn around and I buy those 60 puts, well now ultimately I have limited my risk exposure to the 1 point less the premium that I paid. So my margin requirement significantly drops, my risk exposure significantly drops, and in the event that I am extremely wrong in my outlook, I have half my risk exposure at the lower strike price that I've sold. Okay. Now, ultimately, this is in fact a bullish to neutral strategy. Okay. So we're looking at a market or a pair that looks like it wants to potentially start trending to the upside. But at the same time, we're not sure whether it's going to keep moving or whether it's going to consolidate within the zone. So we want to sell these puts, and to mitigate the risk in selling those puts, we're going to buy that put at the lower strike. Now, when we sell call options, here's a snapshot of the SFC. So here's as I said earlier on in the presentation, one of the pairs that in fact is trending quite noticeably to the downside. And you can see, if I go back and I reference the moving averages, you get a cross down of the moving averages here around 92, and the moving averages have not crossed up. There's been no whipsaw trading activity. Those moving averages have been pointing down, since April. Well, in fact, I'm only showing a portion of the chart. But the idea in this case might be such that, all right, it looks like the SFC, or the U.S. dollar versus the Swiss franc, is going to continue to trend down. We may get a little bit of a snapback, but in that regard, with the trend being down, I want to sell some call options up at a higher strike price and capture some premium in the event that the SFC either continues down or just decides to consolidate within the zone over the next little while. And of course, if that's all it does, as long as below 78. On the expiration date at settlement, then those calls expire worthless. But remember, if the calls actually, or if the pair actually starts to go higher, my risk exposure, I start losing money, and I'm responsible for the difference as soon as it breaks beyond my sold strike price plus the premium I've collected. So the break-even point on a written call is strike price plus premium collected. But let's say, for example, I wrote the 78th, and on the third Friday at noon, and this is a very important consideration, guys, these FX options are settled based on the noon rate of the third Friday of the expiration month. But let's just say, for example, I collected maybe 20 cents down here, and ultimately we have a rally SFC all the way up to 88. Well, 88 minus 78 is 2 points, so that would be essentially $2 per contract, or in fact $200. Okay, so my $20 that I might have collected is going to be settled for a $200 loss, less the premium I collected. So the loss on that would be essentially sorry, if it went to 78, it'd be, or 88, it'd be significantly more than that. But if we need to consider the difference between the strike price and the settlement strike price and the written price. So, again, just to give you another example, let's say wrote at 78, and it actually jumped to 82, then the settlement rate, the value of that option premium on expiration would be $4 or 4 points or $400, and so that would be the loss that I'm responsible for minus the $20 that I've collected. So bottom line is unidentifiable risk exposure. However, if I want to limit my risk exposure, I can still sell the 78 calls, but ultimately I can go in and I can buy the 80 calls. And what happens is my risk exposure is limited to that spread, so 78 to 80, minus the premium that I've collected. And so what I've done is, no matter how high the actual pair value trades within the life cycle of this option contract, my risk is always going to be limited to this level right in here. So very, very important consideration when you're looking at trying to collect premium options writing. Market environments where implied volatility is high is ideal for the options writer, because premiums are historically are priced historically high, and option writers are in fact getting paid for taking the risk. Okay, but with that in mind, there's a reason why premiums are high, because there is an increased consideration of risk. So by creating these call spreads, these credit spreads, be it a bear call spread or a bull put spread, you are limiting and identifying a risk exposure, and you are ultimately lowering your margin requirements as well. Now, the last strategy I want to take a look at here, and then I'm certainly open to taking any questions, and maybe if we have a couple of minutes, I'll just share today's chart, and we can take a look and see what happened. But ultimately, we have here the EUI, and the consideration might be that we don't think within the next month that the EUI is going to trade below 69. So I can sell the puts off at 69, and I can buy the puts down at 68, and I can also, and there's my bear put spread, my bull put spread, and I can also sell calls at 71 and buy calls at 72, and ultimately what my expectations are for the next month is that the pair value is in fact going to consolidate within that particular range. So in other words, it's going to trade within that 69 to 71 range. What happens is that in the event that the pair trades within that range, both my call credit spread on the upside expires and I collect the premium, my put credit spread on the downside expires and I collect the premium, and realistically, we can only be wrong on one side. So in other words, if the just bear with me while I remove that. If the pair value actually drops, well, if the pair value is trading, let's say, down here at 68 on expiration, well, we know that the call credit spread is going to expire worthless. If the fair value is above 72 and we get pinched on that, well, we know that put credit spread is going to expire worthless. This is the iron condor. Okay. Now, when do we use that? We use that when we see a particular pair value consolidating within a specific range, looking like it's established a very strong support level and a very strong resistance level. So where are just getting killed because of the fact that, there's a move that gets underway, then it stalls, then it's underway, then it stalls, it retraces it, and all of that is just serving to eat away at the time premium. The option writers are making money on this the accelerated rate of time depreciation day in and day out as the pair remains within the range. Mike has a question here that the example of being on the daily charts, would we use the same strategies to apply intraday on a 30-minute chart? For myself personally, I'm not an intraday options trader. Now, don't get me wrong. If I buy a call in the morning and it's making money in the afternoon, I'm locking in profit. That's not the point. But I look at utilizing options on a little bit of a bigger time frame. I look at my entries based on the daily charts, and I want to ultimately be able to catch a trend. Ideally, if I'm going to be an options buyer, that is going to give me a few days or a few weeks worth of price action in my favor, so I can take advantage of it. But it all depends on what your preferences are and what you're used to doing. Just keep in mind, for the most part, any and every strategy, option strategy, other than the covered call strategy or the married put strategy, which requires you to own the underlying stock and buy a put option, can be applied in the FX options market. So we can do credit spreads, debit spreads, iron condors, straddles, strangles, condors, ratio spreads, back spreads, calendar spreads, you name it, we can apply it. It just depends, of course, on what your specific outlook is on the particular pair value. So just to conclude the session here, before we take any questions and maybe take a quick look at what did happen today, remember that technical analysis provides a blueprint for strategy selection and position management. So ultimately, we're looking at the charts as a way to help us navigate through the wealth of strategies that we have at our disposal, and understand that although we may love buying puts, sometimes the price action or the pair value action calls for a little bit of a different consideration. Our main purpose is to identify key signals, support support resistance levels, to put odds in our favor when it comes to trading these particular option contracts. And the more time we spend making sure that we've done our due diligence before we click buttons to trade, the higher the probability that we will be successful once we have actually taken action and put that trade on. So guys, just a quick reminder here to visit the FXoptions.com website. It's a fantastic site for all of your FX options information. News and commentary, FX Options TV, the weekly outlook that we actually publish on behalf of the ISE on a weekly basis. You can get some technical insights there. Podcasts, as well as a Traders Open Forum where you guys can chat amongst yourselves and discuss some various strategies and that sort of thing. If you want to know more about Source and what it is that we do, then I encourage you to visit optionsource.net and check out some of the services that we offer. So guys, happy to answer any questions at this point. What I'm going to just try to do here right now very quickly is I'll see if I can share my charts here, and we can take a look at really some of the things that have been happening in the. You guys should be seeing right now a snapshot of the CDD, and so this is what I was talking about in terms of the. You may be just being a blank. All right, just a second here. So hopefully you guys can catch this now. But you know what you're seeing here, guys, is just essentially what's happening today. So in yesterday's charts, remember I talked about the idea of there being a fairly significant pullback, and no surprise because we hit a fairly significant resistance level up at this 99 point. Now that we have a push higher, I want to see whether or not it breaks this resistance level. Okay? So until that takes place, I have to recognize that the CDD has had a very, very significant rally higher, and so I need to meter my decisions in terms of taking advantage of that based on what's happened. Now the other consideration, guys, is that we have a little pivot point right down here. So the more the CDD resists at this 99 level, the higher the probability we're going to get a rejection, as I call it, and perhaps a deeper retracement that gives us an opportunity to maybe buy some put options or create a put spread to capture a move to the downside. Okay, so that's one consideration for the CDD. Let's take a look at the BTX, which was one that we were looking at just not too long ago. Well, you can see here, guys, that we had that break above that pivot point. Now remember, recommendation, so I want to make that perfectly clear right now. But what we've seen is a break above a pivot point. We haven't quite seen our moving averages cross, but as long as the BTX here holds this previous resistance level as support, well, we can perhaps look at a push up into the 63. So what might we look at doing? Well, we might say, all right, look, we may get a pullback here. There's some indecisiveness in these markets. Why don't I buy a 61.50 call option, and I mitigate some of that cost by selling off a 63 or a 63.50 call option. I capture the spread differential, but at the same time I lower my cost basis, I lower my break-even point, and I offset some of the cost of that volatility. Okay, so again, just food for thought as we take a look at what's happened in the event of today's trading activity. We take a look at the EUI. Lots of action. Anybody that followed any short-term charts today, there was some amazing action in the spot market. But for us looking at a bigger picture, we have to understand that we have our resistance levels here still, and we have our support level down here still. So the consideration might be, all right, you know what, you're very indecisive, you're very range-bound, let's create a call credit spread up in here, let's create a put credit spread down in here, and let's see over the next few weeks whether or not we see just this consolidation taking place. So despite the fact, and this is one consideration here, despite the fact that we're seeing MACD crossing, or sorry, not MACD, moving averages crossing up and crossing down, our consideration, as I mentioned earlier on, are these key support and resistance levels for a direction. See a break above 71. All right, now I'm comfortable for perhaps buying some calls on the EUI. If we see a break below the 69 level, I might say, okay, you know what? Now I'm comfortable with perhaps buying some puts on the EUI. So on that note, guys, that's really what some of the considerations that I wanted you to take on, guys. So I'm going to stop sharing my my charts right now and open it up to questions if anybody does have any at this point. And nonetheless, I actually see there are some questions in the quote box here that I was never that I wasn't able to see, and I think we're having some problems with sound, but unfortunately it's a little too late. There's a question from Chris online here. Is there a difference between the FX cash in spot market. Well, the spot cash market, guys. So, Chris, to answer your question, when we're looking at the spot, the currency quotes in the spot market, that is the cash market. That is the actual dealer quote of what the conversion rate would be for a particular pair. Now, what happens with the ISE FX options, for the most part, is it's in fact a purely a conversion. So, for example, the CED has a 100 unit multiplier. So, in other words, with the spot market, let's say trading at 0.9940, we would see a quote for the ISE FX options chart, fair value chart, sitting at 99.40. So, we just simply moved the decimal point. So the FX options charts are reflecting the pair values based on a multiplier of the actual spot market rate as it is trading real time. And what happens, of course, is that options are being priced based on that, considering the number of other variables like volatility, lifetime depreciation, in the money, out the money, out of money. All the same variables that go into pricing an equity option are going into pricing the FX option, and the pair value is fluctuating based on precisely the multiplier used against the spot market rate. So hopefully that helped out, guys, and remember, in the event that options are expensive and implied volatility has accelerated to levels that make it a little less favorable to create a directional bias, don't be afraid to use the call debit spreads or the put debit spreads to mitigate some of that cost. So on that note, I'm going to wrap things up at this point, guys, and Katrina, thanks very much for the invitation to join, and hopefully everybody has in fact been able to generate some insight out of this session. Just one more question to answer here. When purchasing options, does one purchase 60 to 90 days out from expiration? Typically, I do. Typically, I'll use a 3-month contract to participate. But remember, it really has to do with what your particular outlook is. If you have a little bit more of a shorter-term bias, you can use a shorter-term option contract. But for me, I know I can sell those positions at any time. So if a move happens tomorrow, great, I can take my 3-month option out at the same time. The challenge is the move doesn't happen for a month. I'm in better shape with a 3-month option than one might be with a 1-month option that's expiring. So on that note, guys, I'm going to wrap things up for this evening. As always, thank you so much for joining in. Enjoy the rest of your evening. Trade safe. Be patient. Stay strong. This market has certainly been a roller coaster ride for all of you equity traders. Some interesting moves in the currency markets and some real potential for opportunity here as literally the world tries to sort its stuff out. So keep an eye on these FX options, and don't be shy to experiment with them. There's lots of great demo platforms that you can utilize to test your strategies without going live to make sure that this market is for you. So, guys, thanks again. Katrina, thanks as always, and everybody have a wonderful evening. Bye for now.
All right. Thanks very much, Jason. Thanks to all of you also for joining us this afternoon. If you do want to learn more about the ISE FX options that Jason discussed today, make sure to visit fxoptions.com, where you'll be able to see a full list of the available currency pairs and check out the other educational resources that we have on there for you. We do hope to see you all at the upcoming webinars. If you want to sign up, make sure to visit ise.com/webinars. You'll be able to check out the latest schedule and sign up. Thanks again to everyone, and we'll see you again next week. Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.